Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange and ETF Experience, where we're meeting with the top thought leaders and innovators in the ETF space. Joining us for this segment, we have Sean O'Hara, President of Pacer ETFs. We're going to discuss an ETF series that aims to combat inflation and rising interest rates. Sean, it's great to be back on the ground with you again. Welcome to Trade Talks.
Yes, thanks for having me. It's good to see you face to face and in person.
It is. It feels like a high school reunion coming back to such a large ETF conference. Let's talk about the markets and inflation. What are you focusing on right now?
Well, I think inflation is continuing to be a problem and will probably continue to be a problem for quite some time. I think the traditional Fed approach to inflation would be to raise interest rates to try to combat it. And I think they're going to do that, but I don't think that's really the real root cause of it. I think there's still a lot of supply chain issues that are really causing prices to rise. And then you've got sort of global strife with the whole Ukrainian situation. And I think that'll have a real big impact on not only energy prices, but also the price of food. So I think inflation's here for a while. Yeah,
we saw that number come out this morning, and it was pretty glaring that inflation is here. I know that Pacer has an ETF series that aims to combat inflation and rising interest rates. Tell us more about that.
Well, our large cap value and our value suite in general, which we call cash cows, we think would generally produce better returns in a rising interest rate, rising inflation environment. So far, that's really been the case. So cows, COWZ, has a positive return year to date, even though it's 100 large cap U.S. stocks. We're overweight energy, we're overweight materials, we're overweight healthcare, and we're overweight staples. But that free cash flow and that free cash flow yield for companies in a rising rate, rising inflation environment, they tend to do better because they can absorb the shock of those higher input costs.
Would you also say that this is a value play for investors as well?
It is. It's more like traditional value is low price to book, right? That's what Fama and French and all the academics wrote about. We don't use low price to book. We use free cash flow yield, which is the definition of it is the free cash flow you get every year divided by the enterprise value. So it's just in the calculation system. How much am I paying in total to buy the company, market cap plus debt, and how much cash do I get back every year? And the higher that percentage, we think the cheaper the stock. And so we follow that formula. We screen from the Russell 1000, for example, for large cap, the 100 stocks with the highest free cash flow yield. They tend to be good dividend payers. They tend to be stocks that can buy back stock. But the interesting thing about it is that the strategy sort of moves with the marketplace. And so when interest rates and inflation rise, we'll shift from like discretionary to staples, for example. When energy prices were rising here, or when the big energy companies pull back their horns, all that free cash flow comes to their bottom line. So we've gone from no weight last year in energy to an overweight this year. That's paid off well. We were very underweight materials, for example, last year, and we're overweight now. So we own like U.S. Steel, for example, which has been a great stock. And if anybody's following what's going on, the price of raw steel has been going up. That's good for a company like U.S. Steel because their cash flow increases and their net cash flow increases, and that shows up in a higher free cash flow yield. And so that's how the strategy sort of identifies opportunities. 2 years ago, we were overweight technology. So it just sort of follows the market, if you will, and tries to identify those 100 stocks that are the cheapest on the calculation we think is real value today. Because, you know, the interesting thing, Jill, is traditional value based on price to book, you need to see things and be able to count them to determine what book value is. Well, 90% of the stock market's value today is intangible assets. They're things you can't see.
Right.
So you have to identify what's cheap a different way. And the way we think that makes sense to do that is to use free cash flow yield. How much do I pay to buy a company in total? How much cash currently do I get? And then the last thing about the inflation thing is you don't want to own growth in an inflationary environment because you're basically paying today for future earnings, which means that those future earnings in rising inflationary environment have to be discounted. In a free cash flow based system like we use on cows, I'm actually getting a high current cash return. So I don't have that negative effect of inflation on my cash flow.
And I'm glad you explained that because everyone's been wondering, well, why is it impacting technology stocks specifically? So thank you for explaining that. And the Cash Cows 100 ETF, you've seen a lot of growth over recent months, really decent inflows.
Yeah, it's gone from probably about 300 million a year ago or so to over almost 4 billion today.
Oh, wow. It's
been really good.
That is impressive growth. All right, Sean, it was great to see you. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.